Hello and welcome back to Channel 11. This is Ken Shinoda here, your host on Friday, February 4th. I've got Graham Hopper here joining us, colleague at DoubleLine. He's head of our relationship management and advisor group. And thanks for coming by, Graham.
My pleasure. Great to be here.
Brought Graham in. We're going to talk about what's going on in the markets and wanted to see what our clients are thinking out there. So what's kind of on top of mind right now?
Yeah, as you might imagine, rates have moved a lot. Credit spreads, some of them are widening. Equities, we're starting to turn the corner, kind of like what we did last year. And a lot of questions, is this a head fake like what we saw last year with value, with rates, or is it real this time?
Sure.
And what's the Fed going to do? So I think we have some comments lined up today. It should be a good talk.
Okay, sounds good. So start off kind of the themes that we talked about in 2021 on Channel 11 with some of our guests. We had Deputy CIO Jeff Sherman on. And some of the things we talked about were, wanting to stay shorter duration. Clearly that's worked with rates higher, negative year for the ag last year, negative year to start the ag this year as well. We thought at DoubleLine that inflation was going to stay a little bit more persistent than the market expected, not be so transitory. And turns out that's the case with inflation readings hitting kind of like 29 plus year highs.
Yep.
And we thought that securitized credit, given its shorter nature, would outperform corporate credit. And it definitely did both last year and to start this year, with corporate credit now, when I look at investment grade, down over 2%. On the equity side, we were on the buy stuff that's not up so much kind of camp, value versus growth, non-US developed, maybe some emerging markets, the dollar was going to turn lower, and all that stuff worked in the first quarter of last year, and then it didn't work. So I think we're setting up for a different environment where that might be taken over. And then lastly, in alternatives, we've been pretty bullish on commodities. We thought if we do see upside in inflation expectations, commodities should do good in that environment. They had a great run last year. They're up again this year, but they're up a lot. So it's hard to. It's going to be a little bit harder to say how much more room it has to run, but it's still on a long-term basis looks like it's something you're supposed to have in your portfolio. And lastly, we thought that kind of alternative fixed income, private debt, private credit could provide attractive risk-adjusted returns. I think it did. If you look at many of those types of strategies, they're probably delivering high single digits, low double digits. It's just hard when the S&P does like 28%.
That's been kind of the, I had a client once say we're in benchmark hell. It's kind of been that way lately, because as clients are benchmarking against the S&P, but nevertheless, you're exactly right. And I have to say, looking at that, to you and Sherman, 2 out of 3 for a mostly bond shop. I think you got the right ones correct.
We'll
take darn good.
We'll take wins when we get them, and that's been the problem for many people. The more diversified your portfolio has been, the worse off you have been, because the U.S. has just been on fire the last couple of years. So themes for 2022, we still want to stay short. It's still working. In this environment, floating rate credit is going to do well. Year to date, bank loans and CLOs are kind of the two things that are up. Everything else is slightly down, given the rate and credit spread slightly widening. But credit fundamentals are still strong. I mean, if we're not about to enter into a recession, this is spread widening caused by rising real yields. It's also what's causing equities to kind of take a dip here too. So I think this year you're going to see a little bit more volatility broadly in markets, most of it having to do with this move higher in real yields. And that's going to make stocks a little bit more volatile, and it's going to make credit spreads a little bit more volatile. You're already starting to kind of see that happen. I do think rates head higher. We'll look at some charts to show you why. They already have. I mean, if we put this together, maybe 4 days ago, and the 10-year was at like 170, and here we are breaking 190 this morning. One thing to watch is the Treasury curve. The flattening of the Treasury curve sends a signal to investors that there may be concerns about growth coming. Yes, long-term rates are rising today, but the curve is still flattening as the front end starts pricing in policy. So we got to keep our eye on that long end and keep our eye on economic data to see if a recession starts, recessionary signals start coming to the market. So far, with the jobs report today, looks like we're still in a period of growth, at least in the near term. We talked about equities. We still like the value versus growth, non-U.S. developed, EM, if the dollar starts the weekend. And we still like private credit, private. I actually think that type of stuff can do better than stocks in this environment. So you could have an environment when stocks go sideways, maybe earn a slight positive return this year or so, higher yielding fixed income and fixed income alternatives that can deliver high single digits, low double digits. You may be able to outperform equities in that environment with lower volatility. And also, we talked about commodities. They're up a lot. They still provide diversification. And there's some charts you can look at that could argue for continued strength there through time.
Looking through it, the trends or themes aren't that different from last year. I do see across the country with our allocators moving to that private credit or less liquid credit and pulling away from traditional fixed income to some degree, as a 2% portfolio hasn't exactly excited anybody with inflation where it is and equities doing 20+%. But so that's something that we should definitely dive into. And have spreads gotten too tight there, or is there still opportunity? Or
yeah, I mean, look, regardless of where the spreads are there, those type of assets often give you a very high yield, and they don't really have a lot of interest rate risk, right? So most of that direct lending market, either they're short-term loans or they're floating rate loans. Yep. So in a world of rising rates, if this continues, I think that's one of the reasons that a lot of investors have gone to that part of the market. So this is year to date. Again, I have this updated as of the 1st, and then every day I'm like, we got to update this because seen a lot of big moves, of course, recently. But
is Facebook on there?
Facebook is not on here, but the NASDAQ is down 11%, Russell 2000 down 11%. But you can kind of see, look, the Dow, which is more value, cyclical, industrial, is down less. It's still down, but it's down less. Mm-hmm. And you can see the rest of the world, if we look at the ACWI SUS, only down 2.5%. Eurostock only down 3%. FTSE actually positive return. Europe's indices are less growthy. They're more, they have less tech in them, right? So they just are a little bit more value tilted. And so you can see the outperformance there. Now going to fixed income, everything high quality, long duration, obviously down, including tips, because we'll note later that break-even inflation assumptions actually have been dropping just a little bit. And the only place you can have positive returns right now in fixed income, floating rate, bank loans. And if vol picks up, I think that might get erased too. So, last year I was on Bloomberg towards the end of the year. I mentioned to them that I thought cash was a good place to be, and everybody laughed at me, like, how dare you invest in cash because you got to have returns in this inflationary world. Well, my view was that we're just going to have vol and there's going to be some negative returns. And if you had some dry powder, at least, cash doesn't go down and you can buy something. And lo and behold, here you are in a world with a lot of stuff to buy. And the question is, should you start buying it?
Right. That's it. Is it the falling knife or start dabbling?
Commodities on the far right in green. It's not just a rising rate theme in the U.S. It's really a global theme. Here you can see across the globe, rates are going higher except Turkey. And I think this is one of the reasons we're finally breaking out of some of the trading ranges that we sat in the U.S. I've been saying for a while that, you got to watch Europe. It's very hard for the U.S. rates to move higher when the term structure in Germany was sitting negative.
Right.
And finally, Europe's starting to break out. ECB yesterday turned more hawkish, right? And now you're starting to see European yields rise. The 5-year in Germany is almost positive. The 10 years in positive territory. It looks like they're spiking higher, so not surprising. You're seeing a follow through in the U.S., and that's why it seems like we could be breaking out of the trading range that we were.
I saw something on Twitter last night or this morning, and it was talking about it's amazing how much turmoil over a central bank actually not having negative policy. The fact that the ECB may be going to zero. We're talking about zero.
It's pretty remarkable, yeah, but they've been so negative for so long. And the inflation prints in the Eurozone, it's like the highest they've ever seen since the Eurozone was created, which was like back in like the mid-90s, right, early 90s. It's a lot of interesting things happening in the market, creating potentially opportunities. One last view across This is just across the S&P, just kind of showing you what's been outperforming, and value has definitely been outperforming growth by a big amount. And some of that, cyclical stuff like energy and financials doing better. Some of the value cyclical stuff obviously doing better. And it's hard now to say let's buy energy because it's up 22%. Yeah. But I think thematically this shows you that investors seem to be tilting towards that rotation that was happening at the beginning of last year.
Probably could have said that about energy after it was up, 50% last
year? That's true. Okay, so obviously top of mind is what's going to happen with inflation. What's the Fed going to do? How many times they're going to hike? What does that mean for fixed income? So we have a bunch of interesting slides to guide the story. A simple way to think about why inflation happened, especially on the good side, is that this was QE unlike any other QE. Usually QE, there was bond buying, balance sheet would expand. This time we had QE combined with fiscal stimulus. It's almost like we're funding the fiscal stimulus with the purchases of all these securities in the marketplace. And you can see here the big spike in disposable income. These are the stimulus checks that we've been talking about for a while. So not surprisingly, people got the checks. They couldn't go spend it at a restaurant, so they started buying stuff. Jeffrey had this on his DoubleLine Total Return webcast, and I think it's a great slide. It shows you the growth of purchasing of goods, and it took like a decade for that to grow 48%, and then it took like a year and a half for it to grow 48% almost. So this is not surprising. This much demand for goods, fiscal stimulus, or QE does not create more stuff, and we also had bottlenecks. So you see this big spike in the core goods, which is the gray line, right?
And I think that's the question everybody's asking right now. Is you look at that last chart, and if that goes the other way, what happens?
Sure. And if you look at this and you say, okay, if the gray chart, the gray part of this just disappears, so there's actually no goods inflation, and in fact, during many periods of time, goods inflation is actually negative because of hedonic adjustments and stuff like that. Then what you're left is with core services and shelter, right? And that's right around 2%. So that's kind of the Fed, is estimating that inflation comes back to 2%. They're just saying take the gray stuff out. We go back to the blue and yellow, which are terrible colors to choose because it's UCLA colors, but we'll change that to cardinal gold for next time. Now, we think at DoubleLine that the shelter percentages are going to go higher, at least in the near term, because there's a lag between home prices and rent increases, and that coming in through to owner's equivalent rent, right?
Right.
So that's going to happen. How long that lasts to be determined. It's hard to estimate. And we also think that the services component could have surprise to the upside. Look at the disparity of job openings versus people looking for jobs. There's a supply and demand imbalance, and we see it anecdotally in earnings reports at a bunch of CEOs. Everyone's saying that they have to pay more to hire talent.
Yep.
Right.
Wasn't the JOLTS report just coming through at 4.6 million more jobs than unemployed?
There's a big gap, and not surprisingly, wages are on the rise. So here's wages through time. So I think there's kind of near-term pressures for those things to remain elevated. Core goods probably remains elevated too. It probably comes down a little bit, but we at DoubleLine don't think we're going back to 2% core CPI. Maybe it's 3% by the end of the year. Maybe it's a little bit higher. And if we go back to that environment, we look at the decade post-global financial crisis where inflation was, where growth was, and we were at higher nominal yields, average yield around 2.25%, average real GDP and CPI around 2 to 2.5, bouncing around.
Yep.
And that we're almost there. We're at like 194 the last time I looked as I was driving.
Yeah. It just seems though the conversation was consistently last year about inflation being transitory, and then that obviously went away. The two elements that are coming up, whether it's OER being on an 18-month lag to HPA or home price appreciation, or services coming up, those are stickier. Am I wrong?
Those, once they go up, they don't come down so quickly, and I think that a big driver, at least for me on the services side, is the people coming back to the workforce. There's been all these people that left. I know recently, just this morning's job report, we did have more people come back in the workforce, which is why unemployment ticked up to 4%. But I think there's a component of these people that just may not come back. There's a lot of news articles that have been written about like, the great retirement and like people just like quitting their jobs and comparing us to, we used to say that the Europeans were lazy. Well, guess what? Like our workforce, labor force participation is like below theirs almost now. So we're like turning European perhaps. Here's labor force participation and employment to population ratio. Long-term declining trends. This peaked when the baby boomers were in their peak of working. And they were, they really hard workers. That was a generation of like, let's get out there and let's work.
Right.
And that's they're hitting retirement age. So this number is dropping in the employment to population ratio, and the labor force participation ratio is dropping too. This is a problem that many countries grapple with. It's a demographic problem. Japan was one of the first to have that problem. You see a lot of European countries that have this problem. They don't have enough people having kids. Even China, going to that one-child policy is going to hurt them in the long run. In the far right here, you see that once you fall into that 65 and up cohort, the percentage of them that is working, which is on the bottom here, is very low. And it just makes sense. People's stock portfolios are up, their homes are up, they're moving to Texas, they're moving to Florida to not pay taxes, and they're going to enjoy their life. And I just think that there's some percentage of these people that don't come back to the market. So at least in the near term, I think that puts pressure on wages, right?
You have a group of people that their whole culture was to work, like you were talking about the baby boomers. They have wealth now. Why wouldn't you hang it up a little bit? Follow a passion? I don't know.
I think so.
Golf.
I think you're starting to see it happen. And so the market actually kind of is believing that inflation is going to be a little bit more transitory. It's really ironic. This black line, that's when Powell removed transitory from his statement. That's where he said, maybe it's not so transitory. And literally inflation expectations peaked like a couple of days before that, which is really funny.
Of course.
It's still kind of hanging in there, but the market's expectations here at 2.8, I mean, that's still assuming that it's going to come, it's not going to be super high for a very long time. And we'll see. But even at these levels of inflation, if we come back down to, let's say, 3% core CPI or even like 2% core CPI, that's where we were pre-pandemic. So if you let rates normalize, I think you head back up to where we are on the long end of the curve pre-pandemic, and we're almost there. We're kind of in the twos. So we have some more charts to look at that. This is what a lot of people are talking about, real yields. Basically, if you take nominal yields and you strip out the market's expectations of inflation, which is that break-even rate, you get what's called the real yield. It's the yield adjusted for inflation. And it got really negative. You can see here the blue line, which is 5-year real yields, were negative, almost -2. And if you use CPI, you get even more negative. On Jeffrey on his webcast had a couple slides where he used CPI to adjust nominal yields, and they get the most negative since like the Carter administration.
That's correct.
Right?
Yep.
Which is a interesting analogy to the inflation that they saw during those time periods. So with nominal rates rising and the inflation break-evens falling a little bit, boom, you've got this big spike in real yields. It started kind of like right at the end of last year, right, and the beginning of this year. And that's, I think, what's been driving a lot of the repricing of risk assets, and we'll look at some of those charts later. I mean, it's pretty remarkable the difference in the market's expectation of what the Fed's going to do. I went back to the end of the third quarter, so not on September 30th, and you can see at that point in time, the market didn't think we were going to see a hike till Christmas, basically, right? The December meeting, on the left-hand side, you can see expected hikes. So they thought 100% chance of one hike in December. And now I guess the red, that's today or as of February 3rd. And you can see, we were up to almost 5 hikes today. With this big move, we're north of 5 hikes. So the market now thinks the Fed's definitely going to hike 5 times, and the probability of a 50 basis point hike on the first meeting is on the rise. So basically the market thinks that the Fed's going to get pretty aggressive. If they hiked every meeting, they could hike 7. I think there's 7 more meetings till now. And what's going to happen? What does that mean? What does that mean for risk assets, right?
I mean, you talked about it. We've talked about it. It seems like a race for whoever can call the most hikes in this cycle.
Yeah, I mean, each bank's trying to one-up themselves. Goldman was the first to 5, and then Bank of America, I think, came out and said 7. But the one thing that they're not talking about as much, I mean, there's a lot of research that's been written, but I haven't heard about it a lot in in the financial media, is the balance sheet. The balance sheet is insanely big. This chart shows you Fed funds in the red line through time. We've highlighted the periods of QE, and not surprising, of course, when they start QE, balance sheet starts going up, right? They start buying assets on the balance sheet. So balance sheet, this is a percentage of GDP because GDP has been growing, so we want to look at it relative to the economy. And you saw that QE4 ended, balance sheet eventually started rolling off, came back down. We hit the speed bump in 2018. The Powell pivot, he started cutting rates because stocks were tanking and it looked like the economy was slowing. And then voila, the pandemic hit, and look at the balance sheet. It's almost double what it was at the end of QE4, and this huge gap between Fed funds and the balance sheet, and the Fed funds is going to rise, and the balance sheet has to come down, right?
This is a topic that keeps coming up. Is last time we were here, and the Fed maybe has a reputation of supporting the equity markets, and that's what they care about. But back in 18, when you had the pivot, and it was within 2 weeks, went from automatic pilot to, oh, nope, we're going 180 degrees the other way. You didn't have the runway. You didn't have the dual mandate. You didn't have full employment plus headline CPI at 7%. So is this the opportunity for Powell and the Fed to say, we're just going for it. Our mandate is to fight inflation.
They have to show independence, right?
That's right.
So inflation is hot, unemployment is pretty low right now, wages are on the rise, so it definitely seems like you're in a position where that put is probably at a way lower strike price than it was in 2018, right?
And then you have the dual political pressures, right? You have an election coming up, midterm elections coming up, but then you also have inflation being a narrative in which there are constituencies it affects more than others. It's really feels a little bit different this time, doesn't it always?
Yeah, it does, and it's it just as an investor you have to stay diversified, understand there's the risk of kind of derating in price action, but you've had a good run, so
right.
Take that, enjoy that run, and maybe kind of it's time to diversify a little bit more out of the stuff that did really, really well. You're already starting to see some of that stuff come down, and we'll look at some charts on that later. So here are rates. Big move in the short end recently. Bigger move in the short end than the long end, frankly, as the short end starts pricing this new policy of the Fed. And kind of on the long end, for most of 2021, it seemed like we had a ceiling on the 10-year kind of around like 170. I know we broke to 175-ish in March of 2021, but once we rallied down, every time we kind of got back up into the high 160s, there seemed to be a ceiling. It was really hard to kind of break through that. And now we finally have. So it seems like 170-ish, 169 was the new floor on rates, and we had a real hard time getting past up 190. We kept bouncing up kind of into like the high 180s, and today was a momentous day because we just broke above kind of that 190 number, and a lot of it has to do, I think, with the European yields rising. So
right.
It's a very interesting time right now. We're really getting close to 2, which has kind of was my target last year. I thought, we should get to 2. It's not like a controversial target, like bank consensus targets 2. And it seems like the long end, 2% was kind of the magic threshold. I know we broke higher to like 240 in March, but once we came below 2%, every time we got up towards 2 or slightly above 2, it was hard for the market to break through. This year we broke that, and 2 became the new floor, and the ceiling was kind of like 220, and guess where we are today? We're like right there, 220. So if it doesn't hold, I think we're going to break higher up towards the low 2s on the 10-year, and we're going to break up to retest that kind of 240 area, which was the ceiling also in 2019 before rates came down too. So we're kind of we might go back up to that kind of 250-ish area which you can see some support if you drew a line across the long bond. And it's not that far away. You know, fixed income, it's a lot about just kind of riding these markets, and hopefully you have enough coupon to earn your way out of the price declines. That's why just going into the ag is the most miserable place to go, because you have no coupon to protect yourself from the price declines. And so this is a chart I've used a bunch, and I know you're a big fan of it.
Yeah.
It just shows you it's pretty simple. The yield is the blue line. This is the ag. Used to have a much higher yield, of course. And the duration is in the beige. And the duration of the ag used to be way shorter than it is today. For much of the 90s, the 2000s, really until kind of the end of the global financial crisis, the average duration looks like it was something around like 4.5 years. Right. And then, you know, not surprising, with rates so low, everybody wanted to borrow as much money as they could as far out the curve as possible. So the duration of the corporate bond portion of the index extended, the duration of the Treasury component of the index has gone higher. And so here you are with the duration of the ag close to the longest it's ever been. And the yield, not quite the lowest it's ever been, but pretty low. It got down to, looks like, low ones. Now we're kind of coming back up to 2%. If you go back to, let's say, the mid-2000s, the ratio on the right, the gray line, is one divided by the other. So yield divided by duration. If it's north of 1, that means you could withstand a 100 basis point rise in rates and have a positive total return, or a zero total return. If it's north of 1, it can be a positive. If it's south of 1, obviously, assuming no spread changes, it's negative, and it's pretty hopeless here with that yielded duration of 0.2. Not surprising, that's where you're seeing really bad performance out of the ag. Even worse in Europe. Just be glad you're not in Europe sitting there owning a negative yielding bond, although I don't think most investors, average investors, own it. The banks own it. But you have a negative yielding bond with a long duration, there's just no hope.
No, there isn't. And looking at that, to your point, without a deflationary bust, rates plummeting back down to 1, how is that a winning proposition in overall portfolio?
It's not, and that's why, you know, it's a little bit self-serving, but that's why we're proponents of active management and not having to run as much duration as the benchmark, and that hurt us a couple of years. But it's, you know, we think investors that are still with us, they like that. They don't want necessarily as much duration. You can still get protection without a lot of duration, right?
That's right.
You may not have the same price pop if rates fall and things go the other way, but
you're still positive.
You're still positive, and/or you're going to be just less down than equities. I mean, it's still working, even though the 60-40 portfolio is having like one of the worst starts ever to the year. Bonds, they're down, but they're down less than equities. They're creating some dampening. You could sell something that's down 2, and the ag's down a little bit less now. It's down 1 and change. And you can go buy something that's down 13. You can go buy the NASDAQ. You can go buy some of these, you know, really growth stuff that's down. You can go buy ARK. It's down, you know, 50%. I'm not saying to do that.
I don't know that people need more NASDAQ from what
Probably not, but the point being that fixed income can still create volatility dampening in your portfolio. And the higher that yields and rates go, the better the kind of risk-adjusted future returns are going to be for you. So at some point in time, if you're massively underweight, you know, we get back up to 225 on the 10-year, maybe it's time, or even 2%, maybe it's time to start nibbling on some fixed income again, especially given that higher yields and higher real yields maybe means more volatility for stocks.
That's right.
So we talked about rates. Credit looks like it's doing okay. The credit fundamentals are okay. We're not late cycle, I don't think. We're probably not mid-cycle. We're probably somewhere in between. But at this point in time, the credit, our belief in the performance of credit is pretty strong. Here you see that the market thinks so too. High yield default rates, bank loan default rates. If you're in one of our portfolios that owns a lot of securitized stuff, there's a lot of consumer-related debt in there. Consumer also looks like they're in a decent spot. The savings rate is still high relative to history. It's definitely come down with the stimulus checks fading. And then we look at delinquencies across all types of credit: auto loans, credit cards, student loans, mortgage loans. They're down. They're starting to pick up a little bit in like the really subprime credit. Not surprising. They got really low because of the stimulus checks. So we're kind of normalizing. Got to keep our eyes out on it. And then, of course, if you look at, this is a really fascinating chart. Just shows you debt as a percentage of disposable income. And this is from Gerard Manac at Manac Advisors. I have some more charts from him. We really like his work at DoubleLine. And so this is basically debt service coverage, right? How much debt do you have? What's the cost of debt? The cost of debt has so low that this debt service coverage of the average consumer is the lowest since 1964. I mean, mortgage rates are just so low, and that's the biggest debt that most people have, that that cost of debt's low. So this means that the consumer on average does have some decent savings, some decent income, disposable income, and their wages are rising. So if inflation doesn't eat all that away, then on the margin, that should be good for consumer spending, and consumer spending is 2/3 of GDP. So that can paint a positive picture
a bond
for
shop
growth.
with a,
Yeah,
I like
a bond
that.
shop with a positive view.
Here. That's good.
So that's kind of, and the market's thinking that right now. The market does think that, growth's going to remain positive right now. But we know the Fed's going to hike. So what happens in history when the Fed hikes? I'm going to borrow some more charts from, this time, Deutsche Bank. Jim Reed at Deutsche Bank, really like what their team does. A lot of interesting slides they put together. They basically went back to 1955, and they looked at every single recession, and they said, okay, when does it start? How long does it last? How many hikes did they do? And then how many months till the recession? And you can see on average 42 months, median 37. The shortest time period was 1980, which was 10 and a half hikes then. And that's was less than a year to inflation. But that was the super aggressive hikes where we you got up to like 20% here on Fed funds. So I don't think we're getting to 20.
Hope
At least not yet.
Yeah.
So 3.5 years, 3 to 3.5 years on average till you hit recession. So we'll just keep that in the back of our mind. What happens to growth? Well, usually they're hiking because things are going well, maybe too well. So growth actually does slow, but it still remains positive. It slows on average 2.7% year 1, 2.1% year 2 and 3. And inflation actually rises because they're hiking because they want to stop inflation. So inflation actually rises on average a little over 3%, and it goes up the next year actually 4.5%. And during this time period, what do stocks do? Well, they actually do okay the first year. So on average, the return is 7.7%. That's kind of long run equity return average. But you can see this is the blue line. This shows like the price action or growth of $1 of the S&P 500. It kind of peaks sometime towards the end of the year, and then it starts coming down, and then it kind of goes sideways. So starting kind of 9-10 months after the first hike, returns are kind of flat. And that's just, I think the punch bowl is going away, and you see more of a sideways market for equities. Not necessarily, in some scenarios, the gray shades that show you in some scenarios it's negative clearly, in some scenarios it's way positive, and this is just the average. Of course, this is just a tool. It's not going to be just like this, but we look at a range of outcomes, and these are just interesting numbers to have in the back of our mind. What happens to the 10-year yield? Well, it falls into the first hike, kind of what happened recently, right?
Yep.
And then it starts rising, and it rises until it falls again in year 2 and 3 as the economy starts slowing. What happens to the Fed? On average, it flattens 83 basis points in year 1, but it starts at a higher level. So what's interesting about this time, or this hiking cycle, that it's almost like the bond market knew it was coming or thought it was coming and started flattening in anticipation of it. So at least as of when I put this together, which was not today, he says today here, but it was yesterday, it was at 63 basis points. So that would, if it did the average flattening of 83 basis points, you'd end up inverted at the end of the year. Doesn't seem like that's happening right today with the long end going higher, but that inversion is key. Every single time, I know people on CNBC will come out and say, this time is different, curve inversion doesn't mean recession, but almost every single time it does. And normally that happens around 18 months from the inversion. And the inversion typically happens after a year, right? Usually it ends flat, but 6 out of 13 times of those recessionary periods, it did end the first year inverted. So I guess we'll just have to wait and see. But that's why the important thing to do is really watch the long end. Even Drunken Miller was out and said, once the Fed stops manipulating the market, I'm going to start listening to the Treasury yield curve again.
Yeah.
Right? Because it will give you a better signal. When the Fed's in buying, how can that give you any good signal on the marketplace? But if the manipulation is out, then let the bloodless verdict of the market, as Jeffrey says, tell you kind of what's going to happen with the economy.
Yeah, it'll also be interesting. I mean, what happens with break-evens when the Fed is not 25% of that market in the TIPS market?
That's a good point too. So what happens to credit spreads? Credit spreads actually tighten historically after the Fed hikes because the economy is still doing pretty good. And then it starts widening again in year 2 and 3. I think it's different this time. This is the relationship. This is kind of a
complex. Can't help it.
Couldn't help myself.
That's the theme of 2022.
Nominal yields definitely historically have had a inverse relationship to credit spreads. So on the left-hand side is, let's just think about this simplistically, relationship of nominal yield change to change in credit spreads. And it kind of makes sense. If rates are falling, economy is probably doing poorly, something bad is happening, so credit spreads widen, and then vice versa. When the economy is doing well, rates are rising because there's growth, credit spreads are tightening. That is the historical relationship you see in the credit markets. But on the right-hand side, it's the same analysis, but not using nominal yields, using those real yields adjusted for inflation. And you can see towards the kind of last 5 years or so, or like the last decade, that relationship has been drifting more positively. So there's now a more positive relationship with real yields. So in the world of rising real yields, credit spreads could widen. That's exactly what's happening right now, right? You're starting to see real yields move up. They put pressure on stocks, put pressure on spreads. IG spreads are widening, high yield spreads are widening, even in the securitized space spreads are widening. And so I think that's what's different this time from that kind of recessionary, the Fed hike playbook that Deutsche Bank has put out there for us. So everybody's favorite topic, stonks.
It's not rates.
Most people own them. Most people own way more than more stonks than bonds. It's worked so far, and I should probably own more. I work at a bond shop. We're chronically underweight stocks in our PA probably. But
you're getting your opportunity this year.
That's why you gotta get bulled up and watch some CNBC every now and then.
There you go.
Okay, so stocks definitely do not like rising real yields. This is from Goldman. This came out last week after the equity rout began, or was it 2 weeks ago? But this just shows you that we saw a big move in real yields when this came out. It was about 60 basis points, and we saw basically a repricing of multiples down from 19 to 17 in this example. So a lot of investors ask, well, what happens if rates keep moving higher? Well, they did an analysis. Not just rates, but what happens if that real yield keeps moving higher? So if the real yield moved up another 60 beeps, it would take it to being 0. And keeping everything else constant, that would imply a price of 4,000 on the S&P. And if went up 100 basis points, everything else constant, that would mean a repricing of the S&P to 3,800. We got down to like 42.25. So we didn't get quite to 4,000. So the big question is, will we go down more? Right, and it looked like we were off to the races for a second, but corrections typically follow kind of, if you're like market technician stuff, ABC, right? It's an ABC correction. Usually there's the first move down, there's a retracement, and then there's another leg down to retest whatever the lows were, which in this case on the S&P that would be kind of 4,200. I think that's probably going to happen, and it may not. But if that does happen, should you buy? Right, that's the question.
Right. And it just, from the last couple of slides you're showing here, I guess it's intuitive that it seems as negative real rates and the further real rates are negative, the more attractive credit and stocks are. And if it's going the other way and real rates are flat to positive, you have an alternative in fixed income. Money's going to shift back that way. Is it just that simple? I'm sure it's not just that simple.
I don't think it's quite that simple, but
if
real yields are rising, it's going to put pressure on certain parts of the market. it could be pressuring fixed income too, because nominal yields could be going higher, because credit spreads could be going wider. But it seems like the downside risk in the fixed income, as you're seeing already, will probably be less so than in the equity markets.
Becoming more attractive.
Especially because the equity markets are at such a high valuation already from a price to earnings standpoint.
Yes.
Right? And so you're starting to see that correction kind of come into play. This is kind of a fun chart, shows you the fangs with the balance sheet of the central banks, and you just say, uh-oh, well, if the balance sheet starts going down, what's going to happen to the fangs? It's oddly, you put them on top of each other, and it's just this odd coincidence, but it makes sense that there should be some correlation there. I'm not saying you should trade based on this, but we like to look at this chart.
Did they start rolling the balance sheet off yesterday? Think about what happened to one of the fangs yesterday.
Here are all the pandemic stocks, like everything that kind of went to, rocket to the moon, if you will. Big corrections in a lot of these started even before this big move in real yields. Maybe as the market started expecting the punch bowl was going to go away. A lot of them peaking in kind of, I guess in this one, it looks like ARK peaked in Jan of last year.
I'm realizing I need glasses.
Zillow, Zoom, Moderna, here's the SPAC index. So they all kind of like look the same and the same theme. Real yields were super negative. Punch bowl was, their balance sheet was so huge, there was nowhere to go. People looking for growth in the future, and as real yields rise, all that stuff that has cash flows way out in time are obviously coming down. So the big question, of course, should you buy? So Goldman, they want you to buy because they want you to buy stuff from them. So they're going to tell you some historical facts about when to buy. Historically, if you're not going into a recession, which based on the economic data that we follow right now, doesn't seem like things are flashing red, recession imminent. That could change through time. But based on that, if you're not in a recession, average S&P peak to trough, non-recessionary corrections, 21 of them down 15% peak to trough since 1950. That would put the market at 4,100 from where we are at the peak. We got to 4225-ish on the S&P. Market corrections typically are good buying opportunities if we're not going into a recession. So if you believe we're not going into recession, and you believe data, maybe you don't believe data, but in this case, if you believe the past may have some indication to the future, obviously no guarantees, that some place around this 4,100 area, and you're never going to time the bottom, it's probably not a bad buying opportunity on a broad basket like the S&P, right? Maybe not the same for the NASDAQ. So this shows you if you buy 10% below the highs, which is basically right where we got, what's your return through time? The median return over time would be 15. It says 15% here. If you just bought stocks, regardless if they were up and down, you would have gotten 10. So you kind of look at this and you say, oh, why don't I always own stocks? Well, most people do, so I guess that's a good thing.
It's true.
On the right-hand side, doesn't always work. Some years, like 07, you ended up being down 20%. So, could not work out. But on average, if you're not going into a recession, it seems like there's been worse times to buy. Obviously, I think there's a lot of people out there nibbling, at least on that first decline. We could go retest that. That's my base case, is we're probably going to go back down and retest that 4,200. Maybe we get down to that 4,100 area, but it's not that far away, and it's healthy. We needed something like this to kind of shake out the excess in the marketplace.
This chart reminds me a little bit of the old adage of high yield gets 1,000 over in spreads. You got to buy it.
1,000 over is a long ways away
it's
from here.
It's a long ways from here, right?
It has
so
worked.
maybe this is the opportunity right here for buying the dip.
There's a lot of stuff that's down, so I think it's going to be choppy. But if you haven't been adding or you've been underweight, I've been underweight. It's time to nibble. So I nibbled a little bit on that decline here. So through the broad-based equity correction, this is from Minak. He is a reflationist. So now, I'm the bond guy. I'll be negative Nancy. Cyclical, long-term deflation will come in. But what if it doesn't? And I'm kind of on board with Minak here, Gerard Minak, that there are some things that are different this time that could mean that we're going to stay in a more reflationary environment. So all investors should consider that. The market for a while, until more recently, was basically pricing in, we're going back to the new normal, right? We're going back to low inflation, low growth, and in that environment, buy tech, all that stuff's going to do do super well. And now the market's saying maybe that's not the case. So if you look on the bottom left-hand side, it does show you that some of those more value and cyclical sectors are outperforming. They're down, but we saw earlier they're down less. Energy is actually up, but financials are down less. And it's not just in the US, it's happening everywhere. This shows you the red lines, MSCI, ACWI, less US, right? On the right-hand side, going back through time, since 1988, what happens when short-term yields are rising? This is during a hiking cycle, and you can see that the non-US stuff has done better. Developed markets ex-US, right? Emerging markets in China, Japan, UK, positive returns. So that's kind of the theme that Gerard has. I had him on at the end of last year, right before all this started, and he said rates are going to go higher, and all the growth stuff's going to blow up, and the value stuff will outperform. Well, so far so good, Gerard, and we'll see some other slides. He had these. I'm going to reiterate them because I think they're really interesting. So he also agrees you got to watch the bond market. If long-term rates are rising, it's kind of a signal of things are okay. But if we do see long-end rates falling, then this theme of reflation is clearly not going to continue. So this is kind of a complicated chart, but I'm going to kind of walk through it slowly. This shows you PE ratio, and the shaded parts are policy tightening. So you can see that the last policy tightening we had, I know we raised rates like 25 basis points in like 15 or 16, and then we did like nothing, right? But really, it was like 17 when Powell, late 16, early 17, when Powell started kind of the autopilot, right?
Yep.
And so you can see at some point in time during that, the equities derated. And they derated because of a rising risk-free rate. They didn't derate because there was a recession imminent. That's kind of what's going on right now. You're getting a derating because of the rising rates, not necessarily because of a recession. And then, of course, it derated again, but that was during the end of that hiking cycle when people were worried about recession, right? This is like the end of 2018. What do we see? What did we saw? We saw that 20%, peak to trough decline.
What was the 10-year at?
The 10-year got up to 325-ish at one point in time. After taper tantrum, it got to 3. 3 does seem like kind of the ceiling, like at least over the last decade plus. Every time we get to kind of 3, it's definitely held there, and it's been a pretty good buying opportunity. But we're far away from 3, and we'll have to let's get to 2 first, and then decide.
Yeah, we're close. We're closer.
Where things go from there. So,
but that does seem to be a question that we listen, it's crystal ball stuff, but what is that level of the 10-year of rates that starts to really crack the equity market? Well, the equity market's already, at least on the growth side, as we just saw, starting to crack. But is there an idea, is there a rate level where you think, all right, this could cause problems? And I think that Goldman chart kind of showed how that could come down a little bit. But it's a question that keeps getting asked.
I think look at where front end of the curve is. We got up towards like 2.5, and the market cracked on Fed funds, right?
Mm-hmm.
It's probably lower this time, right? It's probably lower this time. Barry Bannister was on. He's from Stifel. He was on like 2 Channel 11s ago, and his number was 1.5. And guess what? The rate expectations of hikes will get us to 1.5 on the high end of Fed funds.
Right.
So basically, by the end of this year,
we're there.
We're there at the point. So we'll guess have to wait and see. Kind of corroborates with the other chart about when the hiking cycle starts. Equities can do well over a 12-month period, but they start peaking after 9 to 10 months. So
right.
I don't know. Maybe we'll see. The view I take is just it's going to be choppy. It's the days of 20% a year. Every year.
It was nice.
It was nice. If you were long, it was good. If you were double long, it was even better. If you were triple long,
then you're on a beach.
3 times as good. Maybe you're on the beach, especially if you own some Dogecoin and sold at the top. But why is it different this time? Well, we had fiscal. It's gone away. We might have more fiscal. Right? I know that the Democrats are trying to bring something else through. But the other thing that really kept us in this cyclical stagnation was that companies really weren't spending, right? They're just buying back shares, right? They got money, buy back shares. But maybe they're going to spend finally. And if we already have the consumer spending. What we need is spending on the corporate side.
CapEx.
And maybe they will. So, what are the themes that could bring that to fruition? Well, one is, of course, this decreased globalization. Bring the manufacturing back home. Can't rely on
we need a
chips.
chip plant here.
Yeah.
Yep.
And you can see that advanced economies, for a very long time, very low investment spending, and it's been growing in emerging markets because that's where the factories are, right? So if we bring it back home, I would think the blue line comes down, the red line goes up, right? So
Makes sense.
That's one thing that could happen. This is all from Manac Advisors. The other thing that Gerard brings up is that there's this potential for increased defense spending. It definitely seems if globalization is going away, there's also more geopolitical tension out there. We're seeing it.
Yeah, there may be a few things in the news.
Left Afghanistan, we went right back into Russia, right? Or right back into the Eastern Europe. So it just definitely seems like investment spending has been very low, and there's a potential for it to come back up. It looks like it's already headed up if you look at this chart. Climate change. Unfortunately, moving towards lower carbon emissions, you need energy to build all the new stuff. And a lot of companies slowed the volume of production. So now you've got this supply-demand imbalance of energy versus demand, right? And you're seeing it in every wintertime, like it's hitting Europe, and it's a big problem in Europe. So in order to get to net zero emissions, this comes from the Institute of Energy something, I forgot what IEA stands for. But this just shows you how much needs to be spent, and it's just huge amounts of money needs to be spent over the next decades in order for us to get to that zero climate change. And these are like things that could cause spending, things that could cause growth.
And it can also be, it seems to me looking at that, could be a bid for commodities as well. A lot of what you just said had commodity related implications.
Absolutely. We were joking about this when we talked about this slide. The infrastructure, is really bad in America. It was built a long time ago, so.
Well, I think it was Monday. I was watching the news. Anybody who knows me, I'm from Pittsburgh, and I probably talk about it too much, but Biden was set to give an infrastructure speech that day. And about 2 miles away from where he was set to give the infrastructure speech, a bridge on Forbes Avenue through a park collapsed with one of the Pittsburgh buses on it. So, yeah,
it's time.
It's time. It is time.
It's time. And just, recently I saw in Detroit, they're going to start putting in, putting in electrical coils underneath the road so cars can charge as they're driving. Right? Oh. So things like that, that could be the future.
Sounds cheap.
Does not sound cheap, and taxes probably will pay for it. And of course, hotter labor market. That's something we didn't have for a long time because there was always excess supply of labor. There was always slack in the labor market. So that was one thing the deflationistas always say is the slack in the labor market, slack in the labor market. Well, guess what? There's no slack in the labor market today, yet they don't want to acknowledge that the labor market's strong. So I guess we'll just have to kind of wait and see if more people come back to the job market. But that's the reflationary view. And the market, if you look at economists' expectations, they're kind of on board with things are slightly better than they used to be. They're not as good as 2021 because that's max stimulus, but things are not as bad as they used to be. So I think the growth outlook, at least for this year, doesn't look that bad. Inflation's probably going to come back down, stay a little bit elevated. So real yields probably head a little bit more higher from here, and causes a little bit more equity repricing, which is our base case. So we talked about what we like in fixed income: stay shorter duration, floating rate assets should do well. Expect some volatility. Credit spreads are probably going to widen. Maybe a good buying opportunity. Alternative fixed income, private stuff, it yields more, not much duration. I think that stuff could outperform equities this year, right? It's been so tough to outperform when equities do 20% a year. But if equities are going to do 5 to 10 even, I'm not saying it'll do 10, you can get that out of some of these fixed income strategies, and I think they'll have less vol than equities. And then we go to our favorites in equities that didn't work last year. They kind of worked for a second and didn't. They're starting to work again. So this is growth versus value. Value is outperforming. This is growth versus value, not in the U.S. Same theme. It broke this trend line here. Here's the U.S. versus the rest of the world looking at PE ratios. And you can see, I mean, look, the US has more growthy stuff, techie stuff in its indices, so it's going to be trading at a higher PE. But if you want to buy what's cheap, doesn't mean that it can't get cheaper too. Here you're seeing that it's getting cheaper. But it definitely, the rest of the world has had more depressed valuations. And going back a decade ago, we traded more on top of each other. Now, why is this? Well, more of our index has become Google and Apple and Facebook.
So you get the question, okay, if we're heading for, maybe Mac doesn't think so, but if you have the camp where we're heading to like rosy, things are slowing down, they're getting a little bit more deflationary, you want to go towards more defensive growth. Defensive growth doesn't seem like it's overly cheap at these levels. Is that the move? I mean, do we have a situation where first quarter looks very good for value and rates are coming up and then it kind of moves back to the old stuff that worked before? How is it different this time?
Yeah, I mean, look, I think you're supposed to just kind of hedge your bets, right? Like it's not 100% probability reflation, and it's not 100% probability deflation. And through time, we're going to get more data that tells us if we're going one way or another. So I think what we have to do is just keep I think people were like, a lot of people were just all in, you know, the growth, right?
Yeah.
And it works. It works.
We're here in California. I travel up to the Bay Area, or at least I used to a lot. Yes.
Just look at home prices. It's working.
It's working
for them.
Keep going.
So I think that, look, the valuations are coming down a lot. If you didn't own much of this, you know, non-U.S., more value, maybe you're supposed to add it, and vice versa. If you didn't own much of the growth names, they're down a lot.
Right.
So
here's an opportunity.
Here's an opportunity to start kind of, nibbling. Hopefully you didn't nibble on Facebook right before the drop 25%.
Let's stop beating up on the Facebook folks.
Yeah, it's too easy.
Yeah, I know.
Here's U.S. equity prices versus the rest of the world. It has consistently looked cheap. I look at this chart and I probably would have said, let's buy in 2015, 16, 17, 18, 19, 20, 21, 22. So, but maybe this time is different. Of course, look, it's been this huge outperformance. People have been talking about the U.S. outperformance ending for years and years and years and years, and the U.S., America just keeps winning and winning and winning. I think, again, not a bad time to kind of diversify, add to these other pockets that are lower valuations if we see kind of a change in this growth and inflation theme, and rates coming higher.
You have a potentially big inflection point with potential staying power from central banks right now to be going the opposite way of what they've been doing for almost an entire 12 years.
They have to, yeah, and that's kind of the big difference. They were basically zero forever, right?
Yeah, and they now have a runway.
I mean, the zero started right here in 2009, and that's when you saw that massive outperformance in U.S. equities, and now it's going the other way. So, I don't know, a lot of these charts, it just seems like the move up was when rates were zero, balance sheet was growing, and as things move the other way, there's a potential for a reversal of these trends. S&P 500 versus MSCI Europe. Obviously, Europe has some pressures going on geopolitically, but you gotta, geopolitics are always going to be there. There's always going to be issues out there. You kind of just have to try to kind of look through the vol, I guess, look through them. S&P versus EM, same story. EM is a little tough because the dollar's been strong, and if the Fed's going to hike, you think that the dollar's going to, have some strength here. So we've been talking about EM a lot. It's massively underperformed. Valuations look cheap, but it's hard to catch a falling knife until that dollar starts weakening, which we think would be that's a better time to buy. And the dollar, it seems like it bounced off this 98 level, and we're watching this. Jeffrey is long-term negative on the dollar, but short-term, had been constructive on it, and it definitely seems like, let's say we break through that trend, that support there, Fibonacci 38.2 retracement, then it seems like we'll break lower. So we're keeping our eyes on the dollar, and a break lower would get you more bulled up on EM. And last but not least, commodities. I still remember the big run-up into the global financial crisis when commodities were ripping. Late cycle. We thought that might be the case a couple of years ago, as we thought we were kind of ending into the late cycle. it was a head fake, didn't work.
Yep.
But then, more recently, commodities have been on a tear, and relative to the growth in the stock market, there seems like potentially a little bit more upside here, especially if this reflation theme continues. It's hard, it's up a lot, but I think when commodities move, and they keep moving. It's like once that trend breaks, you could see big moves there. So it's not something you want to add to your portfolio and own like always, because there's long periods of time when it's like you just did nothing for you. But look pre-global financial crisis at the continued kind of almost outperformance of commodities relative to equities in that time period, which was, by the way, also a time period where a lot of that kind of value and cyclical stuff was doing well too.
I remember talking to clients back then, younger back then, much less white hair in my beard, but if you didn't own commodities back then, you were crazy. Everybody, and the Jim Rogers super cycle for commodities, driving his motorcycle through China. Over the last, is it 4 years now, 3 years now, we've been talking about commodities. Here's a potential place to start to diversify. And individuals look at me like I have 10 heads because it's just underperformed for so long at this point in time. And you say, yes, they're up a lot, but up a lot relative to what? Everything else is up significantly more.
Yep. So that's it. Those are we covered fixed income, we covered equities. We'll see if those contrarian trades, maybe not so contrarian anymore. It seems like more people are jumping on the bandwagon. But get in, I say hold on to your seatbelts. It's going to be, I think, a wild ride this year, and be patient and try to take advantage of some of the volatility. Right, when there's high volatility, there's buying opportunities, but you got to be patient. But you're never going to time the bottom, right? But at some point in time, you got to start nibbling back on fixed income, please. Yeah. Right. You got to start nibbling at some of these equity markets that cheapen up.
So for when we're thinking about rates, shorter duration. Staying shorter duration. If you're thinking about credit and credit allocation, it can do okay in this environment, I think is how you like to put it. It can do okay.
It can do okay, but it's going to be a bumpy ride. Right. We're going to see some spread widening. You're already seeing it right now.
If you're owning it now, or you're buying it now, or you're repositioning now, are you moving up higher in credit quality, or are you moving down in credit quality? Are you looking to, on any kind of vol, like if we have vol today, you're trying to buy lower credit quality? I know this is one day, but generally speaking, where are you positioned right now?
It's not there yet. I mean, it's credit spreads are just starting to widen. They're like widening a little bit.
There you go.
And you want, if rates weren't moving higher, like real yields weren't moving higher, and we weren't more negative about kind of broader risk asset pricing, then in normal times, especially if there was a lot of bond inflows, I would say go buy. But if you look at the bond, and I didn't put it in here, I should have put it in here. Bank of America puts out some like bond inflow information that shows you the amount of inflows through like the first 3 weeks of the year versus this year. And last year, the first month of the year, there was tens of billions of dollars coming into bond funds. Tens of billions.
That's correct.
Right, and it was just new deals would come in the market, and it was just a food fight. Like I couldn't buy enough bonds relative to what I needed to buy for our portfolios. This year is the complete opposite. There was negative flows out of bond funds. So
except for floating rate funds.
Except for floating rate funds. And guess what's up?
Bingo.
Bank loans are up, right? Bank loans are the only fixed income sector that have positive returns because they've got money coming in and buying. If you can predict fund flows, you can predict the direction of spreads, because one of the biggest, for credit predominantly, because one of the biggest buyers of credit products is going to be all these different mutual funds that are out there. So I think that, if there's a scenario that creates selling pressure, don't sell, buy. Wait,
rotate.
Rotate and wait for that selling pressure. So we're kind of waiting for some scenario that may create a little bit more selling pressure. It's a buyer's market, but we want it to be, a real buyer's market where there's limited buyers around. So if you're the buyer, you can demand a wider spread. We may not get there. We may, stocks may rip higher, credit spreads stabilize here, but there is a chance, and I think, like I said, in equities, I think we'll go retest that 4,200 area. Maybe we go a little bit lower. And in that scenario, I think credit spreads are going to kind of widen more potentially. We're approaching 400 in high yield. That's kind of like a critical number that people look at. So let's just keep our eyes out on it. We are staying patient. We've kind of gone up in quality in some of our portfolios. We've raised cash in some of our opportunistic portfolio because there is nowhere to hide. I mean, if credit spreads widen, they all widen. So, you know,
there.
people laughed at me and said, you can't own cash, but cash doesn't go down in price. So we want a little bit of dry powder. We got some, you know, higher quality assets we can also sell to buy credit. And I think there's going to be a decent buying opportunity coming. You just got to be patient about it.
Got it. Thank you. And I will say that thank you for putting this together. I know that our clients always appreciate it, hearing directly from you, whether it's this way or when we're doing calls together. So the work is much appreciated, and thanks for staying in front of everybody.
My pleasure. Thanks for tuning in. Thanks for your support at DoubleLine, and good luck this year, everyone.
Take care.